That's right. So what we're hearing is that this race is speeding up, so to say, because of some of the volatility out there, because of uncertainty over the economic outlook. Now, we've known that these companies were likely to go public in 2019 for a long time, but what's speeding up here is the time frame looking towards the first half of next year. So that valuation for Uber is expected to be around $120 billion now. So that is a significantly higher valuation than the most recently public option, which was around $76 billion. This is a huge company that would be going public. Lyft, its competitor, is a little bit smaller, but still massive company. Like you mentioned, Slack is a messaging company that's also likely to go public, around $15 billion. So the outlook here is really strong for some of these tech companies. And the question is if, once they're public, some of the issues that have been holding back their growth, particularly losses for Uber and Lyft, if that's going to be enough for investors to say they're still really into these stocks when they're on the market.
One problem, if you've got a company that is almost identical in the sense that they're offering the same type of service, means that the investor community gets dragged into that listing first. They put all their money into that basket, and they may not want to buy a similar service. For instance, like a Lyft or an Uber that's kind of the same.
And if you get your full allocation, then you're in trouble.
Right.
So you won't be putting all your money in.
That assumes there's still a large amount of money that wants to directly go into ride-hailing services.
Sure, but if an IPO isn't oversubscribed by a multiple, then you know there's a problem straight away. Then the sponsors have got this horribly wrong. So you're right, people might want to put all their eggs in one basket, but they won't get all their eggs in one basket if it's any good.
So you think the money's going to be there, it's going to be waiting, ready to go into some of these tech names?
Just follows on from, I think that, yeah, the money will be there if it's priced properly, won't it?
It's a narrowing window though, isn't it? I mean, it's a narrowing window because the game is up for a lot of these businesses. I mean, the one thing that I thought was instructive that I picked up when I was out doing our East Tech West event, that there were 40 of these bicycle sharing companies. They blew through $2 billion, and now there are 4. If that doesn't indicate what we're going to see replicated across a whole swathe of e-commerce, then I'm a Chinaman.
And one of the things we're seeing when we hear about these companies are that if they don't have ride sharing, if they don't have scooters, if they don't have food delivery all in one, they're not as likely to succeed. And that's something that Uber has done successfully. Lyft has not been as successful in getting kind of all of the segments into its one business so far.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.